SoftBank just lost 6% of its market value in a single trading session. That's billions of dollars evaporating in hours. And it's not because of some isolated bad earnings report or management scandal. This is a full-blown repricing of the entire AI investment thesis that's dominated global markets for the past 2 years. And here's what makes this moment so significant. SoftBank isn't some niche player betting on AI in the shadows. It's one of the world's largest institutional investors, with the Vision Fund controlling more than $60 billion in assets specifically targeted at AI and tech companies. When SoftBank moves like this, it's not noise, it's a signal that professional money is reassessing whether the AI boom actually delivers the returns everyone's been promised. Today's collapse across Asian tech stocks, Samsung, TSMC, and dozens of semiconductor and AI-exposed names all tumbling together, tells us something uncomfortable that most financial media won't say directly. The market may have gotten way ahead of itself, not because AI isn't real or important, but because the gap between AI's actual near-term revenue and what investors have already priced into these stocks has become genuinely dangerous. For the past 18 months, if you mentioned AI in a product roadmap, your stock went up. Today, that logic reversed. And when investor sentiment flips this hard, this fast, there's always a deeper story driving it. So let's dig into what triggered this seismic change. To understand today's crash, you need to rewind to about 18 months ago. The moment ChatGPT exploded into mainstream consciousness, a new logic took over Wall Street. AI was going to reshape every industry, so any company touching AI would be a winner. It's a simple, seductive story, and simple stories move money faster than complex ones do. SoftBank's Masayoshi Son became one of the loudest voices amplifying this narrative. He publicly declared that AI would be bigger than the internet revolution, and he backed that belief with real capital. The Vision Fund loaded up on AI infrastructure plays like chip makers, cloud providers, and AI software companies. Meanwhile, other megafunds and retail investors followed the same breadcrumb trail. The result was a classic feedback loop. More demand for AI stocks meant rising prices attracted more buyers. More buyers pushed prices even higher. Tech companies that had mediocre profitability but good AI marketing saw their valuations soar. A semiconductor company shipping to data centers could see its stock climb 80% in a year, regardless of whether those data centers were actually generating returns on their AI spending. The problem, and this is what today's sell-off is exposing, is that much of this capital was chasing a narrative, not actual profits. AI infrastructure investments take years to generate revenue. Many of those data centers are still half empty or burning cash. And gradually, very quietly, the questions started shifting from "Will AI win?" to "When will it actually make money?" That question is what triggered today's earthquake. Let's be precise about what actually shifted. Enterprise AI adoption is real. Corporations are genuinely experimenting with large language models and building AI tools. But there's a massive difference between experimentation and massive, sustained spending. What investors discovered over recent months is that many companies treating AI as a competitive necessity still haven't figured out how to monetize it. A bank might deploy an AI chatbot to handle customer service, which is genuinely useful. But if it cuts their customer service costs by 20% instead of 50%, the return on that AI infrastructure investment is way lower than the vendor promised. Here's the part most people overlook entirely. Much of the AI spending boom happened because vendors were subsidizing or bundling AI features into existing products, not because customers voluntarily chose to pay premium prices for AI specifically. That can't last forever. Eventually, you hit a wall where customers demand proof that AI is actually delivering outsized value, not just modest improvement. And the financial reports trickling in across June and July have been exposing uncomfortable gaps. Utilization rates on AI accelerators aren't climbing as sharply as expected. Customer acquisition costs for AI software are rising. And here's what's genuinely alarming to institutional investors. We are now 18 months into the AI hype cycle, and revenue growth from AI-specific products is still single-digit as a percentage of most tech company earnings. That's a massive red flag. If the world's biggest tech companies with the most resources can't convert AI investment into proportional revenue growth after a year and a half of intense focus, why would smaller companies succeed? This realization is what caused SoftBank and other mega funds to step back and ask a different question. Have we paid too much for this too early? You might wonder why a 6% drop in one Japanese conglomerate's stock price matters globally. The answer is that SoftBank isn't just a company, it's a proxy for what the smartest institutional money is thinking about AI's trajectory. Masayoshi Son built SoftBank's reputation on making bold, early bets. He bet big on the internet when it was niche. He bet on mobile when skeptics ruled. His track record means that when SoftBank's Vision Fund moves, other funds pay attention. The Vision Fund has invested in more than 500 companies globally, with a massive concentration in AI and semiconductor plays, NVIDIA, ARM, OpenAI, and hundreds of smaller startups building on top of large language models. When those bets were working, SoftBank was a hero. Magazine covers featured Son as a visionary genius. Now that the returns aren't materializing as fast as expected, the same capital is rotating out. Think of it like a massive ship changing direction. It doesn't happen instantly, but once it starts, the momentum is unstoppable. Other large funds, Sequoia, Andreessen Horowitz, Tiger Global, have been quietly raising dry powder, which means they are sitting on cash instead of deploying it into new AI ventures. That's classic behavior when conviction starts to crack. When you combine SoftBank's visible retreat with the broader pullback across institutional investors, you're looking at a potential end to the aggressive AI funding environment that's defined the past 18 months. This matters because startups that were burning through $50 or $100 million a year raised at sky-high valuations suddenly face a reckoning. Their burn rate is unsustainable at new, lower valuations. Here's where the story gets genuinely interesting to investors and anyone holding tech positions. When SoftBank's stock fell 6%, it triggered a cascade. Samsung, which supplies memory chips to everyone from Apple to Amazon's data centers, dropped sharply. TSMC, which manufactures chips for NVIDIA and other AI vendors, followed. Even companies not directly in the AI infrastructure chain, banks, software firms, manufacturers, caught secondary damage because traders assumed the entire AI will solve everything narrative was overextended. This is textbook momentum reversal. In an uptrend, good news about one tech stock creates a rising tide that lifts all boats. In a downtrend, bad news about one anchor player creates a vacuum that sucks capital out of the entire sector. The difference in magnitude matters. A 6% drop for SoftBank doesn't sound catastrophic on its own. But when it cascades through Asian markets, it triggers algorithm-driven selling in American markets, which amplifies the damage, which makes investors globally nervous about their own AI exposures. You end up with a situation where a rational repricing of one company's valuation becomes an irrational fire sale across an entire sector. Compare this to 2022 crypto crash, different asset class, similar mechanics. When Luna exploded, it didn't just hurt Luna investors, it created questions about whether the entire crypto narrative was overblown, and those questions spread contagion through every crypto-exposed position globally. The AI sell-off we are seeing right now has the same flavor, though it's more justified because it's based on actual misalignment between expected returns and reported results, not on fraud. If you're holding any tech stocks, or if you have a 401k or index fund that includes tech exposure, today's move directly affects your money. The question becomes, is this a 6% correction in an ongoing bull market, or is it the beginning of a 30 or 40% repricing of the entire AI investment thesis? The honest answer is that nobody knows with certainty, but we can look at the evidence. Earnings growth for AI-heavy companies has been modestly disappointing relative to the price expectations built in. Capital expenditure at cloud giants like Amazon Web Services and Google Cloud is accelerating, but revenue growth from AI-specific services is lagging behind that capex, which means returns on invested capital are deteriorating. That's the metric that sophisticated investors watch, not revenue, but return on capital deployed. If you're spending $10 billion a year on AI infrastructure, but only capturing $2 billion in incremental revenue from AI products, you're destroying shareholder value, not creating it. The second issue is valuation compression. Many AI-adjacent stocks are trading at price-to-earnings multiples of 40, 50, even 80 times earnings. That's only justified if you expect 30 or 40% earnings growth for the next decade. If earnings growth slows to 15%, which is still fantastic, by the way, those multiples need to compress sharply, and multiple compression is the invisible force behind most market corrections. A stock can have positive earnings news and still fall 20% if the market is repricing its growth assumptions downward. That's what's happening now. The implication is that patient, lower leverage investors have an opportunity to buy quality AI companies at lower prices in coming months. But speculators and over-leveraged funds are getting liquidated right now, which is why we are seeing this violent move. If you're trying to figure out how to navigate the next 6 months of this market, here's the practical framework that sophisticated investors use. First, distinguish between AI as narrative and AI as business. Companies that are actually generating meaningful revenue from AI products, not theoretical future revenue, but money in the bank today, will weather this correction much better than pure-play infrastructure vendors or startups with no clear path to profitability. Look at the business model. Is the company selling to price-sensitive customers who will abandon the product the moment something cheaper comes along? Or is it solving a problem that's genuinely hard to replace once integrated into a customer's workflow? Second, pay attention to cash burn and runway. Startups that raised $200 million at a $2 billion valuation 18 months ago are now facing a world where investors expect the same company to be worth $800 million or less. If that company is burning $10 million a month, it has roughly 2 years of runway at current burn. That's actually survivable if management cuts costs and focuses on revenue. But if it's burning $30 million a month, it's in genuine trouble. Either it needs to raise fresh capital at a punishing down-round valuation, or it runs out of money. Third, watch for consolidation. When capital dries up and investor confidence cracks, strong companies buy weaker ones at fire sale prices. We're entering the phase where that happens aggressively. Companies with proven revenue, strong balance sheets, and reasonable valuations are going to acquire smaller competitors that can't raise funding. This is how markets reset. The weak get absorbed or disappear. The strong get stronger and cheaper as a buying opportunity. Here's what today's SoftBank sell-off and the broader AI stock correction really mean. AI is real, it's transformative, and it will reshape industries. But the timeline for that transformation is longer than markets priced in, and the path to profitability is messier than the hype suggested. That's not a condemnation of AI, it's just reality. Revolutionary technologies always follow this pattern. The internet took years to move from hype to actual economic value creation. Mobile faced the same cycle. Even electricity had a massive bubble and correction before it became the foundational infrastructure of the global economy. What's happening right now is the market learning the difference between AI is going to matter, which is definitely true, and therefore all AI-adjacent stocks are good investments at any price, which was never true. The investors losing money today are the ones who confused those two statements. The investors who'll win over the next 3 to 5 years are the ones who use this repricing as an opportunity to buy genuinely good AI businesses at lower prices, and to avoid the zombies that were only alive because venture capitalists were throwing dumb money around. If you're working in tech or AI, this moment matters because it separates projects with real product market fit from those that only had venture funding fit. If you're an investor, it's a chance to be greedy when others are fearful. If you're just watching the market, understand that volatility like this is normal and healthy. It means the market is doing its job of reallocating capital from bad ideas to good ones. Follow for daily AI news to stay on top of how this story unfolds.